Good morning, everyone, and welcome. Welcome, Ken. Thank you very much for joining. So it's a pleasure to share the stage with you today. It's a great pleasure and great honor. So today we'll talk with Ken Tropin. He's chairman and founder of Graham Capital. I'm sure most of you are very familiar with the firm, but I'm still going to give just a brief, maybe, overview of the firm. So the firm was founded in 1994, focusing mostly on macro strategies, but not only. I mean, you do other things. I know you started some long-short equity strategies a few years ago. But I think the bread and butter of the firm is still macro, both
that would be correct. Yep.
Quant and discretionary.
About 70%.
70% macro. So a very macro-focused firm, founded in 1994 again. Very long track record, very successful firm. So again, very, very excited to kind of pick your brain and get all of your insight about not only macro, but about the industry as a whole here. So yeah, so welcome.
Thank you very much for having me. My pleasure.
So maybe to start with Graham, right? So Graham was founded in 1994, over 30 years ago at this point. And you had long tenures at Graham, and that's not typical in the space. You see a lot of turnover. So what do you think, what makes people stay, at Graham specifically? What is it about the culture?
Well, maybe to start from the top down, the way I look at having a successful hedge fund, it's all about having the best possible people. And if you have the best possible people, I mean, there's no way to have the best outcome without the best people. And if you have the best people, you have to invest in them. You have to really make it part of your strategic priority as an organization, that their careers, they feel, are going successfully, their health, their well-being. Part of our culture at the firm is to really be focused on these things. It sounds a little soft at the edges, but it's really meaningful. And as a result, for example, we have 235 employees at Graham. 40% have been there more than 10 years. So that's very unusual in our business.
Yes, yeah, especially in this environment where there's like a war for talent, and all this is kind of, it's kind of hard to keep talent. So I guess culture still matters at the end of the day.
I mean, I think it's really important. I think, we're in a world where, obviously the competition for bright people in the hedge fund space is intense. It's as intense as it's ever been. And to differentiate ourselves, we've tried to have a culture of collaboration, of creativity, of innovation, and frankly, of warmth towards our employees. And I think that's paid a lot of dividends in terms of having people stay committed to the organization over decades.
I have to admit, when I visited your offices, I actually felt that warmth. So the interesting thing here is that you don't only have long tenure within the firm itself, but your clients, externally, you also had pretty long tenure. You have clients. I think your 5 initial clients are still invested with Graham today. So why do you think that is?
Yeah, it's kind of an amazing thing that I didn't quite realize. When I started Graham, it was 31 years ago. I did so with the help of Paul Jones, who's an old friend of mine, and he was my original partner at Graham. And when I started the organization, we went to Geneva and met some of their clients. And some of those clients, 5 of them, took a chance on a brand new hedge fund called Graham back in '94. And, as I look back, those 5 investors are still all investors. And one of the amazing things is that, I think you can attribute it to the fact that it's a close relationship that we've enjoyed over 30 years, and we look at our investors as partners, not clients. That's
impressive. I mean, to see clients staying for over 30 years, through the up and downs of the market, various market cycles, and still sticking with the firm.
Yeah, we've given a couple reasons to leave over the years, but somehow they're still with us.
Good deal. So let's maybe switch to the, more specifically to the macro discussion here. Obviously, there's quite a lot of things going on in the world right now. Geopolitical tension, changes. There's some conflicts. There's tariffs. The picture for macro here is pretty rich. But why do you think currently, at NEPC, for example, we've been getting a lot more questions, interest. We're setting up educational sessions about macro specifically, but about diversification overall. So why do you think there's more interest in macro right now? And a related question is, why do you think it's specifically a good environment for macro at this point?
Yeah, so there's definitely a lot of interest in macro, and I think I can just sort of quantify that by saying we probably have 3 or 4 times as many client meetings in the last couple of years than, say, we might have had 5 years ago. So obviously people are interested in what we do. But why are people interested in macro is really your question, and there are a lot of reasons. The markets are much more interesting. If you think about the period between 2009 or 2010 post-financial crisis and 2021, and you looked at the ECB and the Fed and the Bank of England, there were only 13 25 basis point rate moves between those 3 central banks in 11 years. And in the subsequent 36 months, there have been 60. So you could say that the opportunity set for a fixed income trader is something like 20 times more interesting, 20 times more action. And then you go from there and you think about valuations in equities or record highs as we sit here today. And a lot going on in the world that could upset the apple cart, not predicting that, but certainly from a valuation perspective, things are stretched. And then if you look at the geopolitical situation, it's never been more unstable, in my opinion. And then when we look at bonds, which would normally be the diversifier people would go to try and have some sort of hedge in their portfolio, a deficit, the biggest it's ever been, really spooky, really no easy way to understand how to manage it lower, no obvious effort being made to do so. And so we're in an environment where stocks are really expensive and bonds are kind of scary. And I think people then look at macro and say, gee, this is something that's not at all correlated to stocks and bonds. That makes a lot of sense to me of why I might want to start allocating some portion of what we do to macro.
Yeah, that makes a lot of sense. So maybe digging a little bit deeper into the diversifying benefits of macro, right? So when you look at macro going back to the GFC, even on a granular basis, quarter by quarter, looking at quarters when equities were down, macro typically protects, and sometimes is even actually up substantially when equities are down. That's a fact, right? When you look at the return profile. But I want to understand what are the attributes, right, that actually make macro so diversifying, and to kind of deliver that zero correlation with a 60-40 portfolio.
Sure. First of all, let me start with the first sort of comment. We don't always make money when it's bad for stocks and bonds. We generally have had some pretty good performance in cycles that have not been good for fixed income or for equities in particular. 08 comes to mind, 87 comes to mind, 2003 when the tech bubble burst comes to mind. We've certainly had some good performance cycles when it was very, very valuable to investors, but there is no way that I can say to clients, we're always going to do that, because we don't. We might be on the wrong side of it. We could be long equities and they go down and we're losing money. At the same time, our clients are hoping for us to be that hedge. We do, however, trade tactically, and we can switch from being long equities to short equities, and obviously can benefit from falling prices as opposed to just being sort of residually long, and it's just a question of to what degree. And then some of the things we trade just aren't correlated at all to equities, and therefore what's happening in foreign exchange or what's happening in commodities or something like that, might not be correlated either. So for those reasons, we tend to be at least something that's not acting exactly the same as the rest of their portfolio.
Yeah, that make a lot of sense. So I think that the distinction here also, if I hear you correctly, is that an uncorrelated return profile doesn't mean negatively correlated necessarily.
Yeah, I mean, we hope to be negatively correlated when clients need us most. We have about 2/3 or 3/4 of the time, but definitely there's some times where we've been exposed. We just don't stay that way forever. If markets have some kind of extended decline, we're going to go short.
That's really insightful. So maybe diving a little bit deeper into the macro segment and maybe focusing a little bit more on the quant side, right? So I think you started managing quant strategies. I think you actually developed some of the early models at Graham.
Yep.
Even actually prior to that, you were already doing quant macro. I want to, there's so many things have evolved so much in the past, even just 5 years, right? So data is more available, the type of data, alternative data, there's AI, machine learning. In your opinion, in the past, let's say just 5 years, how that evolution has affected quant strategies, and going forward, what do you think it takes, for quant strategies to still stay performing in the future?
So I would say this, and this relates not just to quant, but to any type of hedge fund investing. You always have to be looking around the corner to see where the next opportunity might be to generate alpha that everybody else isn't also looking at. I mean, there's just no way to be successful over time if you're not always pushing the boundaries of innovation, period. And in quant, it depends on the type of quant investing we're talking about. If we're talking about trend following, that's a pretty straightforward using momentum signals to follow trends. If they're trends, usually you're doing pretty well. If there are a lack of trends, probably not. And if you're getting trends that are, moving in the opposite direction of the previous direction, you're probably struggling. And in an environment such as we've seen in the last 6 or 8 weeks, where the policies of the current administration have been really volatile, the market reaction's been really volatile, and the speed at which these policies are changing is tough for a medium-term time horizon. If you have quant strategies that are high frequency, or if you have quant strategies that are quite tactical and short-term in nature, they can do a lot better in this kind of an environment. In terms of some of the things I'm excited about in quant, I very much like the idea of quant strategies that are not just based on price, but also that are based on fundamentals, things that look at yield and carry, relative value. All of these things are complementary if the architecture is really well done.
So maybe I just want to go back to the trend following comment you made. So, I've seen some trend following strategies kind of adding some of the, economically based, factors, signals within the trend following system, adding, things like equity factors. Do you think that kind of dilute the price-based, basically rational behind trend following, or does it complement it, and does it help it mitigate some of those period of reversals that we've seen year to date?
Look, I think it's additive, right? I mean, at the end of the day, people love trend followers. In a year like 22, when we really performed at a time where very little else worked, it's hard to be loved if you're not performing. And so, I'm one of those people that I take enormous pride in our performance, and I am really stressed out unless we're delivering some kind of returns that make our clients happy. And accordingly, it's really a priority at our firm to always trying to be looking at things that can be additive, that can provide non-correlated sources of alpha, that can, in general, improve the information ratio or Sharpe ratio of what we do. Easier said than done, but it is a very big focus at our firm. And every cycle, and I've been doing this literally for 45 years, every cycle that hasn't been good for what we do, to me, has been a catalyst to say, roll up our sleeves, and let's really work hard at figuring out how to do a better job of this market character next time we're going to face it.
And when you say, doing a better job, so do you think that AI and machine learning has a place in that?
Yeah, I mean, the world is telling us how important AI is, right? And to not pay very close attention to how the tools associated with AI can enhance how your hedge fund generates alpha would be really naive, I think. Having said that, it's not so easy to do it successfully. And we've started a task force recently to make sure that as a firm, we are looking at every way that AI might help either discretionary traders or our quant models. And for example, in the quant model side of things, it can really expedite research and how fast we can test different ideas. What we don't necessarily have a lot of confidence in at this time is just asking the computers to design trading systems. We think it has to be done in a pretty closely supervised fashion.
Very insightful. So Graham does both quant, and we talk a lot about quant here, but also discretionary. So how do you think those two type of macro flavors, right, complement each other?
Yeah, so it's a very good question. We started as a quant firm, back in '94, and then in '98, we started doing discretionary trading. And part of it was because Tudor was my partner, my closest friends in the business, and they said, Ken, just doing quant, it's going to be too hit or miss. You should diversify into discretionary. And so we did, and we started off, in fact, hiring a few Tudor traders that were small fish in a big pond there. Ultimately, we hired a fantastic Fed watcher, former member of the New York Fed, named Fred Levin. He was amazing at predicting what the Fed would do and what they weren't going to do. And we started a fund around him that had an absolutely fantastic track record. And then ultimately, he retired, around 15 when monetary policy was on hold, and he said, Ken, there's just nothing for me to do. But he really got us started in the discretionary business. And in, I think, 1999 or 2000, we started a fund called Proprietary Matrix, which was half discretionary trading and half quantitative trading, and it was meant to replicate how I invest proprietary capital. And then over the years, our discretionary business at times has been the bigger business, and more recently, the quant business is slightly bigger. I think we're managing 20 billion, 12 or so in quant, 8 or so in discretionary. And discretionary, by its very nature, relying on people and not machines, is harder to scale. And it's obviously very competitive, finding very, very good traders right now. But we are also seeing a lot of really interesting people. So even though it's hard to recruit, I feel like there's a pretty good opportunity to do so right now.
Interesting. And so you're talking about competition here. So I think probably the elephant in the room is multi-strat platforms, right? Hedge funds. Obviously multi-strat have grown a whole lot in the past few years. I just want to ask you, what do you make of that argument, right? That multi-strat can actually deliver a close or similar level of diversification as global macro, but with the potential to even get, to deliver even better returns. So that's the first question. And so a related question is, how do you stay competitive versus, multi-strat, in this environment?
Yeah, so tackling the first point you made, The multi-strat firms, the most successful of them, I mean, all you can do is respect what they're accomplishing. They're delivering really consistent returns for their investors with phenomenal risk management. And hats off to them. Having said that, if you're a CIO at an institutional investor or a family office, and you have a specific exposure that you're trying to add to your portfolio, that's not what you're getting from the large multi-strats. They're doing that. So you might have a 20% sleeve of macro within their big fund, but if you want to specifically allocate to macro, that's not happening. That's just not who they are. I think for us to be successful at Graham, it makes no sense to me to try and just copy what the big multi-strats are doing. Rather, I would make it a virtue, think of ourselves as a virtue of a necessity is that since we're not going to do that exactly, what we can do is work with clients in a partnership fashion to give them a very custom investment solution rather than a one-size-fits-all fund. Or, in a very straightforward way, if clients want a macro exposure, let's say they want it to be discretionary, they want it to be some blended discretionary and quant, they want it at a certain level of leverage or certain volatility target. We think of ourselves as somebody who is prepared to sit down with the CIO of an investor and say, tell us exactly what you're looking to build or what your exposure you're trying to get from Graham. We'll try and provide that if we can. So it's not one size fits all. And then I would say on the competing for talent side of things, I think here's where culture is really important. You know, if you go to the largest multi-strats, they're so large that maybe culture doesn't get completely lost, but it definitely gets a little watered down because these are gigantic organizations now. 240 people at Graham, we're still very focused at every level of management on, you know, how are our people treated, how are they feeling about their lives, or, you know, are they successful both at the firm, are they happy externally, because all of these things matter. And we try and provide an environment that encourages collaboration. That's not necessarily what you get at a big multi-strat platform. You're given capital, you're given risk limits, and maybe not even encouraged to collaborate because they're really striving to have the lowest correlation between the portfolio teams as possible. We kind of take the opposite approach. And for some people, having both the best economic, you know, compensation, but also a place where you really feel like you're part of something has allowed us to be pretty competitive. And then most recently, we opened a New York office. After resisting that for 30 years, I finally said, in order to compete these days, I've got to have a New York office. And very quickly, it's allowed us to recruit quite a number of very capable people.
I think that's is really interesting because so you're encouraging collaboration, but you're still delivering very low correlation between those discretionary teams as well, right?
Yeah, I mean, look, there are definitely times where the correlation between the different teams in our discretionary business is higher than, say, it used to be on average 10%, which is pretty low. And then there are times today where it is higher for sure, but that's because there's more going on that's pretty significant, and people, you know, we're gonna have some crowded positions. However, we have so many different time horizons at Graham, people that are really short-term, really tactical. They tend to be not very correlated with people that, say, trade over a 1 month or 2 month time horizon. So, you know, we're managing through all of that. And if there's a big move, you kind of want people to have it, right? If you get a situation like gold moved up a lot or Bitcoin moved up a lot, right? Or the dollar's gotten really weak, you know, you don't want to miss it. So there's a balancing and an equilibrium between being in the moves that matter, but not being so concentrated that from a risk point of view, it's not so great.
Interesting. And talking about time horizon, right? You're talking about the complementarity in time horizon in the discretionary team. So specifically for thematic discretionary right now, with all the short-term volatility, all the policy-driven short-term shocks that we're getting, that are probably going to be here for the next few years, right? How do you think thematic macro is going to be able to adapt? Because it's typically a little bit more longer-term in nature. So what do you think?
It's really hard to know exactly, but my sense is out of what feels like a very chaotic, policy, policies and changes to policies that are happening in Washington, I think that's going to calm down. I don't think we're going to see that for the foreseeable future. I mean, you got the midterm elections coming up in a year. It's inconceivable to me that we're going to have the administration ignore everything and just go, okay, tariffs today, Friday we're postponing them, Monday we're re-announcing them. That stuff's going to calm down at some point. It's just inconceivable to me that it's going to accelerate from here. How could it? So I think it's just going to contract in terms of what's happening, in terms of the spontaneity of it all. And, I think that will make it easier for our models to take advantage of, the moves that ultimately prevail out of that.
And so you talk about all the geopolitical, tension, I mean, there's tariffs going on and all of that good stuff. I remember reading a book from Amy Chua a long time ago, World on Fire, right? And it's an oldie, but I think it still applies today. So I literally feel like the world is on fire right now. So what are you optimistic about in this current environment?
Well, it's a little bit of everything. I mean, I think here's the interesting thing. The Fed, right, knows that these tariffs are inflationary. So they can't really be as dovish as they'd like to be. We know there's going to be a new Fed chairman 9 months from now, or whatever it is. The rumor's been Kevin Warsh. He's no dove. He's more hawkish than Powell. So I think it's kind of interesting to part of what we do is Fed watching. It's interesting to see what the central bank, both in the U.S. and in Europe, is going to do. And then it's, obviously the geopolitical situation just seems to me, I think it was a big goal of Trump to try and be the peacemaker in Eastern Europe and in the Mideast. Didn't happen. And so these things are going to stay relevant for a while. And, I think you've just got so many moving parts to the global economy. And then you think about the thing that's most on my mind is, do we get a situation where people get spooked by bonds? For 25 years, there's been no premium for taking duration risk. So duration risk, people not familiar with that term, means if you own a 10-year bond and its yield is the same as a 5-year bond, but you're committed to that interest rate for 10 years instead of 5 years, and if you're not getting a premium for taking that time horizon risk, at some point people could find themselves, oh my gosh, interest rates are going up, and all of a sudden my yield is subpar to current rates and I've lost a bunch of money. When I started in the business in 1980, or I started in 77, but in 1980, interest rates went from something like 6 or 8% to 20. People got killed in duration risk and bonds. With the deficit the size it is, with these tariffs alienating global investors in U.S. fixed income, and with the uncertainty about how to solve this deficit, to me, the canary in the room to watch is the bond market. And do people get spooked by bonds in a way that we haven't seen in a really long time? And that could really have a profound effect on both, not only fixed income, but also equities.
So uncertainty is a key word here. Just in 20 seconds, I know you joined the Robin Hood Foundation, I think. Why and what you've been doing? Can you tell us a little bit more about your involvement there?
Well, I've been on the board. I've been a donor to Robinhood for 30 years, 35 years since it was founded in '89. Paul's an old friend of mine. He started the organization. We grew up in the business together. It was always, you know, for those of you unfamiliar, Robinhood fights poverty in New York City. I joined the board 10 years ago. I became chairman this year. To me, it's really simple. No matter how much money I give to Robinhood, it doesn't change my life, but it profoundly changes the lives of the people we try and endeavor to support and to move from poverty into successful careers.
Fantastic. All right, well, we're out of time. Thank you very much again, Ken.
My pleasure completely. Thank you for having me.
Thank you.